Bitcoin's inflation hedge promise in tatters, why investors are reevaluating digital gold. For years, Bitcoin supporters promoted one powerful idea: Bitcoin is digital gold. The argument was simple. Governments can print more money, which may reduce the purchasing power of traditional currencies over time. Bitcoin, however, has a fixed supply of 21 million coins. That scarcity was supposed to make it an ideal hedge against inflation. But in 2026, that narrative is facing one of its biggest tests yet. Bitcoin has suffered a dramatic decline from its 2025 all-time highs, falling roughly 36% from major peak levels, and at one point, dropping nearly 50% from record prices above $126,000 reached last year. While inflation concerns remain elevated across many economies, Bitcoin has not behaved the way many investors expected. Instead of protecting portfolios from inflation, the world's largest cryptocurrency has often moved like a high-risk technology stock. Today we're examining why Bitcoin's inflation hedge story is being questioned, what caused the latest downturn, and what this means for investors going forward. To understand the current debate, we first need to revisit the original Bitcoin investment thesis. When Bitcoin was created in 2009, it introduced something unique: a decentralized digital asset with a hard cap on supply. Unlike fiat currencies controlled by central banks, Bitcoin's issuance schedule is predetermined by code. Supporters argue that this made Bitcoin immune to monetary debasement. As governments expanded spending and central banks increased money supply, Bitcoin's scarcity would theoretically preserve value. This idea became especially popular during the pandemic years, when massive stimulus programs and aggressive monetary easing fueled concerns about future inflation. Institutional investors, hedge funds, and even public companies began accumulating Bitcoin as a potential hedge against currency weakness. The nickname digital gold quickly became part of Bitcoin's identity. However, reality has been more complicated. During several major inflationary periods over the past few years, Bitcoin often moved in the opposite direction investors expected. Rather than rising alongside inflation fears, Bitcoin frequently sold off whenever markets anticipated higher interest rates. This pattern became even more obvious during 2026. Despite ongoing concerns about inflation, Bitcoin experienced significant declines, while traditional inflation hedges such as gold remained comparatively strong. Analysts began asking a difficult question: is Bitcoin truly an inflation hedge, or is it simply another risk asset? Recent market data has intensified this debate. Bitcoin started 2026 near the $90,000 range, but later fell sharply, touching levels around $60,000 before recovering somewhat. Even after rebounds, prices remain well below previous records. Investors who expected Bitcoin to provide protection against economic uncertainty have instead experienced substantial volatility. At the same time, gold has significantly outperformed Bitcoin during periods of heightened inflation concern. This divergence has challenged one of the cryptocurrency industry's most widely repeated narratives. Market strategists increasingly point out that Bitcoin's behavior has become closely linked to broader risk sentiment. When investors feel optimistic and seek growth opportunities, Bitcoin often performs well. When investors become cautious and move away from risk, Bitcoin frequently falls alongside speculative assets. That is not how classic inflation hedges are expected to behave. Another important factor is the relationship between Bitcoin and interest rates. Many investors originally believed inflation alone would drive Bitcoin higher. But markets don't operate that simply. When inflation rises, central banks often respond by maintaining higher interest rates or delaying rate cuts. Higher interest rates tend to strengthen traditional fixed-income investments and reduce appetite for speculative assets. As a result, Bitcoin can actually face downward pressure during inflationary environments if investors believe monetary policy will remain restrictive. Several studies and market analyses have highlighted this contradiction. Bitcoin may respond negatively to inflation surprises because investors anticipate tighter financial conditions rather than focusing solely on currency debasement concerns. Institutional flows are also playing a major role. One of the biggest developments in cryptocurrency markets over the past few years has been the rise of Bitcoin exchange-traded funds, or ETFs. These products made Bitcoin accessible to a broader range of investors. When ETF inflows were strong, Bitcoin benefited enormously. But in 2026, the situation changed. Billions of dollars have flowed out of Bitcoin ETFs, creating additional selling pressure and signaling weaker institutional demand. Several reports indicate that investors have been reducing exposure to cryptocurrency as uncertainty surrounding economic growth, interest rates, and geopolitical risks increases. This shift matters because institutional participation was one of the key drivers behind Bitcoin's previous rally. Without consistent inflows, sustaining higher prices becomes more difficult. Corporate Bitcoin holders have also felt the impact. Companies that accumulated large Bitcoin positions during the bull market have experienced significant paper losses as prices declined. The most notable example is Strategy, formerly MicroStrategy, which remains the largest corporate holder of Bitcoin. The company recently reported substantial losses linked to Bitcoin's decline, highlighting the risks associated with concentrated cryptocurrency exposure. Another reason Bitcoin's inflation hedge reputation is under pressure involves changing investor psychology. In previous years, concerns about government debt, deficit spending, and currency debasement fueled enthusiasm for alternative assets. This trade became known as the debasement trade. Investors bought gold, Bitcoin, and other assets they believed could protect purchasing power. But recent data suggests enthusiasm for this theme has weakened. Both gold and Bitcoin ETFs have experienced outflows, indicating that investors may be moving away from the debasement narrative altogether. Some analysts argue that investors are becoming more selective. Instead of buying Bitcoin simply because inflation exists, market participants are increasingly evaluating its actual performance during inflationary periods. And so far, the results have been mixed. Critics have become more vocal. Economist Nouriel Roubini, one of Bitcoin's longtime skeptics, recently renewed his criticism of cryptocurrencies, arguing that Bitcoin lacks the characteristics required to function as a stable store of value. While supporters strongly disagree, the recent downturn has given critics additional ammunition. Yet despite all this criticism, Bitcoin supporters remain optimistic. Many argue that focusing solely on short-term price movements misses the bigger picture. They point out that Bitcoin has experienced multiple drawdowns exceeding 50% throughout its history, and has repeatedly recovered to establish new highs. From this perspective, volatility is not evidence that Bitcoin has failed. Instead, it is simply part of Bitcoin's long-term growth cycle. Supporters also emphasize Bitcoin's continued adoption. Major financial institutions are expanding cryptocurrency services. Regulatory clarity continues improving in several jurisdictions, and Bitcoin remains one of the most widely recognized digital assets in the world. The central question now is whether Bitcoin can evolve beyond its current identity as a speculative asset. If Bitcoin is to fulfill its promise as digital gold, investors will likely need to see more consistent performance during periods of inflation and economic uncertainty. Until then, many market participants may continue viewing Bitcoin primarily as a high-risk growth asset rather than a dependable inflation hedge. The truth may lie somewhere in the middle. Bitcoin's fixed supply gives it characteristics that resemble an inflation hedge. However, its price remains heavily influenced by investor sentiment, monetary policy expectations, institutional flows, and broader market conditions. That combination creates a complex asset that doesn't fit neatly into traditional categories. As we move further into 2026, Bitcoin's future will depend on whether it can regain investor confidence and demonstrate resilience during challenging economic conditions. The debate over digital gold is far from over, but one thing is clear. The events of 2026 have forced investors to rethink long-held assumptions about Bitcoin, inflation, and the future of money. And the answer to whether Bitcoin truly serves as an inflation hedge remains one of the most important questions in modern finance. Thanks for watching. If you enjoyed this analysis, be sure to like the video, subscribe to the channel, and turn on notifications so you never miss our latest coverage of cryptocurrency, global markets, and the biggest financial stories shaping the world today.